On August 7th, 2025, President Donald Trump signed an executive order titled Democratizing Access to Alternative Assets for 401k Investors. What does this mean? Well, what it does is it paves the way for private investments and cryptocurrency. So think private equity, hedge funds, private loans, all these alternatives that were previously only accessible for very high net worth people, very high income individuals, now making them available to the masses. So tomorrow you're not going to see a private equity hedge fund available in your 401k plan, but you might see something similar to that down the road. And that begs the question is this a good idea for investors? If you see one of these pop up in your 401k plan, should you invest in it? Should you consider it? How could you go about evaluating these investments? It's complicated. It's very illiquid. The risk can be very high. The returns can be high, but historically, yes, you will find examples where people made eye popping sums of money by investing in a hedge fund, venture capital. It happens all the time. But if you look at averages, if you look how most people do when they invest in these types of investments, it's just meh. And so the trade off then for the illiquidity, the higher risk, it's just not worth it for most investors. So let's talk about why, even if it becomes available in your 401k plan 6 months, a year, 2 years from now, whenever that might happen, should you consider one of these funds? Well, in theory, it sounds great because you have a set menu of funds and investment options that are available to you in your 401k. And a good investment menu would include anywhere from maybe 10 to 20 choices. Anything above that, it's too much. The research shows that actually, if there's too many options, if you have like 60 investment options to choose from, you have this paralysis by analysis and participation ends up going down. So people just throw up their hands and they're like, no, 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 no. I'll figure this out later. I'm too overwhelmed by the choices here. So, right off the bat, my concern with adding these funds to an investment lineup is it's just one more investment option. A good 401k lineup is the diversified lineup of funds that have a good, solid track record. And that brings me to the next point, which is a lot of 401k employees, when you see the menu of funds available to you, you think that that's just your employer's just rubber stamped that and said, whatever ones you choose, doesn't matter. They're all great. What a lot of people do when they're looking at their 401k plan options is they will literally just like scan the list and be like, oh, okay, that's the best performing fund. I'm going to pick that one. Now, thankfully, most 401k employees will go with the target date funds, which are diversified. It's what I usually suggest to most people. But for people who do not choose the target date option and they're trying to design their own custom lineup of funds, what ends up happening, and I've seen this many, many times, is they will pick the best performing option. So if you throw in some private investment in there, they're not going to throw in a dog with fleas. They're going to put a good quality one with a good track record. But how did that fund do in the great financial crisis? How did it do in a really bad down market? A lot of these funds are not going to have long term track records that are accurate. So you can see what it has done, how it has performed in various market cycles. So, inevitably, what people will do is they'll just be like, oh, that one has, it's returned 20% on average for the last 10 years. I'm picking that one. And they put all of their eggs in that basket. In general, this kind of falls under the principle of avoiding specialized funds. So it's not just private equity or crypto, but if you have access to a technology fund or a gold fund or an energy fund, these are commonly included in 401k menus, and I don't like them. In fact, I have a number of 401k plans plans that I manage and hundreds of participants in those plans. And if I take over a plan, I become the advisor to that plan, and I see that they have these specialized funds, I am like begging them, can we remove this fund? It doesn't make sense. Now, one interesting counterpoint to this that I actually agree with is an article that I read recently in Barron's. And the author of this article, his name is John Toomey. He's the CEO of Harbor Vest Partners. And which, by the way, is a private equity firm. So he has a vested interest in seeing this come to light and seeing more 401k plans adopt his types of investments. Not to be all conspiracy theory, but I question who's going to benefit the most from these funds, but that's a topic for another day. The question today is this a big opportunity or a hard pass? And so one of the areas where I think it does present an interesting opportunity and something to consider if you are understanding the risks, if you understand the volatility, if you are capable of doing your own due diligence and research, which honestly in a lot of these private investments, they're so complicated, they're so complex, they're wrapped in weird layers of debt, and it's like you need a PhD in, like, economics to just understand a lot of these funds. He says that, these funds, these private equity funds, they're highly concentrated, they're very risky, they're only for people who can really afford to have their money tied up for years and years and years, and then hope, cross your fingers that you're gonna get some type of return. But he makes an interesting point in saying that right now there's only about 2,500 companies that are publicly traded, give or take. But it's something like 40% less today than it was 20, 25 years ago. So you've seen this huge consolidation. Companies buy other companies, companies go out of business. Most of the wealth in the stock market is concentrated in the largest, most cash rich, most successful companies, and then everybody else is sort of left behind. That has come with a lot of benefits the last few years, but there's also a lot of risk there too. And his point that he makes is that there are almost 300,000 companies that are backed by venture capital or private equity. If you want to introduce more diversification, tremendously more diversification than what even exists in the stock market today, you should be including private equity, private investments. And so he makes a really interesting point about diversification. And that is one of the main problems that I have with the stock market today is that the dollars in the stock market, the trillions of dollars that investors have in their 401k plans is just feeding a handful of companies at the top. And that's great while they're doing well, but when the music stops, and it will eventually stop, it will. I'm not saying this year or next year, but the problem is that the companies that are sucking much of the stock market wealth, the expectation is that these companies will continue growing into perpetuity, and that's just impossible. There's an ebb and flow. So all the future growth projections are then taken back and tied to the stock price today. Investors are betting that these companies are just going to keep growing all the way to the moon, and that's just not going to happen. My gut feeling is that this is still a hard pass. Most investors do not have the time, the resources to be able to tolerate the kind of risks that many of these private investments carry. I'm skeptical. That's where I'm at. I think that there could be diversification benefits, but the trade-offs that aren't going away, extremely high volatility, higher risk, and most 401k investors are simply not going to do the due diligence and have the knowledge base and the resources to do that. And so I think a lot of people in the long run, if these are made available in 401k plans, are going to get burned. I think you can build a diversified portfolio as long as you don't stick it all in an S&P 500 index fund, as long as you do a little bit of due diligence on, like, if you're using a target date fund, you can diversify broadly within a 401k plan. You don't need the private equity, you don't need the crypto. You can do that outside of a 401k plan And I think that's where it belongs. Hard pass, not a big opportunity. We'll see if these become available inside of 401k plans. And if they do, you want to consider all the risks and make sure you fully understand these types of investments before you commit your hard earned retirement dollars to them. If you're new to the podcast, a little bit about me. My name is Ashley Michike. I'm a financial advisor and co owner of True North Retirement Advisors. For the last 18 years, I've been helping my clients retire with confidence. And that's exactly what I aim to do on this podcast, help to distill all the complex retirement planning questions into just clear answers so you can enjoy living, stop worrying about retirement, and make sure that you have enough money to last through your retirement. That's my goal here. And I appreciate you taking the time to hang out with me today. I'll see you next time.